Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Simplify's Mike Green to discuss his personal portfolio and the macro strategy that he deploys that sits at the heart of one of Simplify's new ETFs. Mike's macro strategy combines equities with positive convexity, managed futures that are diversifying and inflation sensitive, and a suite of fixed income sources with low sensitivity to duration. Mike walks through the investing rationale for each of these and explains how they work in the context of the overall portfolio and why he believes these exposures will be important return sources in the future. As always, thank you for listening. Please enjoy this Show Us Your Portfolio episode with Simplify's Mike Green. Hi, Mike. Thank you very much for joining us today.
Hey, Justin. It's great to be here with you.
We're going to talk about your personal investment strategy. So a little bit different than the last conversation we had, but we like to bring on professionals like yourself and talk about how you think about managing your personal portfolio and your investments. And the neat thing with you, and this is also with some of the other folks we've had on, but is a lot of your portfolio, or a big way that you manage your portfolio, is through an actual strategy that you run within an ETF wrapper. So this conversation will give us an opportunity to talk about your views of the world and how that manifests itself in an actual strategy that you run for your own capital and also many other clients. So this is going to be a fun and interesting conversation.
I certainly hope so. It sounds it's an interesting opportunity. I love the opportunity to chat about where opportunities exist and kind of what I see as the overall story. But the funny part is that we're going to skip straight ahead and talk largely about the fact that we're being given an extraordinary opportunity to pick up excess return in the form of U.S. Treasuries. So that's going to be the lion's share of our conversation around debating those points. But I'm looking forward to it.
We always like to start out at sort of a high level with people that we have on for this type of episode, which is when you think about your personal investments, what you're trying to achieve and accomplish with your portfolio, how would you explain that to someone?
Well, so I'm in an interesting situation in which the single largest asset that I own is actually the equity in Simplify and various other investments that I am either directly involved in the management of or that have significant exposure to in terms of the success of those ventures, right? So combination of Simplify, Tier 1 Alpha, and I've done things like that in the past, running my own hedge fund, et cetera. Now that naturally changes your profile from a risk standpoint. And it puts you into a situation where you're already deeply exposed to risk assets. And so in most situations, ironically, I find myself probably underexposed to risk assets because so much of my income stream and the value of the assets that I invest in are tied to markets in one form or another. Now, with that said, the portfolios that I'm constructing also, represent kind of my personal philosophy, which is that you really want to manage a portfolio based on the payout structures embedded in the portfolio rather than the quote unquote asset classes. And so when you think about exposures, I try to emphasize for people that equities, remember what you're really doing. You're going long a call, you're going long a put. You have the upside and you have the downside basically to the bankruptcy point, right? In fixed income, you have limited upside and all the exposure to the downside. In exchange for giving up that upside, you're receiving an income stream, right? So like when you start thinking about portfolios in that construct, you start thinking about, well, under what conditions do I actually expect to get paid? What payoff structure is going to work under this cycle? And that is largely how I try to construct my portfolios. If you look at the strategies that I run, which are publicly available, they reflect a lot of those fears that right now there's much less upside than there is downside in terms of overall exposure in terms of the markets. And interestingly enough, you can now actually obtain fairly significant compensation for simply giving up that upside at the same time that you don't have to participate in the downside, what we call riskless bonds or risk-free bonds, the U.S. Treasuries, that offer a really attractive return relative to at least what I see as the inflationary conditions that are in place right now.
And we'll get into a lot more detail on those exposures and what those asset classes are. But one of the interesting things for you personally that we learned in preparing for this podcast was you either are selling your house or you recently sold your house, and I think you're going to take the opportunity to get in an RV with your family and travel across the country. So maybe just can you talk to that a little bit, like what drove that decision?
Well, so this is one of the things that I always emphasize for people. We live in a very financialized world where we tend to think about, all my behaviors are determined in some form or another by whether the Federal Reserve hikes interest rates or not. But the simple reality is that we actually have to live our lives as well. And that's part of the frustration, I think, that you feel from people. They shouldn't have to focus on markets nearly as much as they do. I do it because I love it and because I would do this no matter what. But you hit life stages and different things happen, right? So in the simplest form, we're all born short housing, and over time we accumulate a shelter exposure that if you live your life reasonably well and you're fairly lucky in terms of raising your kids, and I seem to have been so, you find yourself over-provisioned for housing. So suddenly, instead of being short housing, I'm now long a couple of acres of land and over 4,000 square feet in Marin County, which I have absolutely no need for because my children are never coming back, at least if I have anything to say about it, right? And so it's basically me, my wife, and my 2 dogs that are suddenly saying, why in the world are we wandering around this place? Now, as a testament to my market timing and my wife's superior ability to do that, like she desperately wanted to sell last year. I looked at it and I said, look, we probably are going to take a bath on this, but we've got kids that are finishing out high school. We don't want to disrupt them in this process. That's going to prove to be a very costly mistake, by the way. But the kids probably would have forgiven us at least after many millions of dollars worth of therapy. But so we're actually we're now just at that life stage where we're empty nesters. We have no reason to own a big home. And my wife and I really just want to go explore for a little bit. And so we're going to hop in an RV. We're going to drive cross country, see if we can tolerate each other in very close quarters for a couple of weeks. And then from there, we've got a series of short-term rentals all over the United States. And I think one of the fun things will actually be, seeing if I can get, Twitter meetups and go out and have drinks with people in places that I don't normally get to hang out. But really just kind of wander for a little bit. And I'm incredibly fortunate that my career gives me the ability to be relatively flexible as long as I can get a decent Wi-Fi signal.
Yeah, and the idea of doing that now, I mean, some people would wait until retirement. They'd say, I can't, I gotta be working. I gotta either be in the office or be at my home office, or, wouldn't have the mindset to sort of be able to think they could do that. I mean, we're lucky, like you said, we're in jobs that you can pretty much work from anywhere. But I think oftentimes people wait too long to do things like that. And then by the time they're 70 or 75, health issues come up and it becomes much harder.
Well, I also would toss out a second component, though, right, which is the benefit. And I've had the flexibility of this. I've encouraged people on other podcasts, if you have the ability to do this, take semi-sabbaticals, right? So I've taken breaks from my work career where I've been, basically thinking and writing for a year or so. That has positioned me to have some of the best breakthroughs of my career in terms of, what's actually going on. How do I think about the world? All my work around passive actually emerged during that type of sabbatical in 2016, where I stumbled across Lasse Peterson's paper, Sharpening the Arithmetic of Active Management. And it was literally like it was like a lightning bolt struck. I'm like, oh my gosh, wait a second. He's not going nearly far enough in this. For those who aren't familiar with the paper, Lasse challenges Bill Sharpe's seminal paper, The Arithmetic of Active Management, in which Bill Sharpe makes the often cited observation that all active together has to equal passive, and therefore the only difference is going to be fees on average, and as a result, passive outperforms over time. Lasse recognized that there were periods of time during index reconstitution in which the passive players had to transact, right? And so I'm reading this paper and I'm like, wait a second. passive players receive flows, they're constantly transacting. Therefore, they can't meet their own definition. There has to be another mechanism at play here. And that's where a lot of my work emerged from it. I'm hoping for something very similar, where I'm taking basically the next year away from being tied to a particular location, being tied to a particular setting, and continuing to stay active in markets, continuing to stay active managing the portfolios, but just doing a sabbatical from normal life is kind of the easiest way to think about it. Hopefully that's going to spur a lot of interesting thoughts, and it'll give me some of the same opportunities that I have. We were talking earlier about jumping into Twitter spaces, right? It gives you an opportunity to see the world from somebody else's perspective.
Yeah, that's something I found in life too, is like I have this tendency to think if I'm not, like, with my head's not down and I'm not grinding, like I'm not working. And so, like, a lot of times when you get away from things and you kind of give yourself some time to think, you end up doing some of the better things, you coming up with some of your better ideas, or doing some of the better things you do in your career. So I would totally agree with that. Like, and it's a flaw of mine that I always tend to think I have to have my head down working all the time.
I don't think that's a flaw of yours. I mean, yes, I agree, by the way, that can work to your disadvantage. But I think most of us that have gotten to this point in our careers recognize that hard work is a big component of the relative success that we've had. I tend to emphasize for people, particularly tied to the work I've done with, guys like Ole Peters, et cetera, the role that luck plays, right? If I had not been born in the United States at the time that I was and had the experiences and exposures that I did, probably wouldn't be anywhere, remotely close to doing what I'm doing today. But it is really important to give yourself that flexibility to step out of your life, to step off of the desk, to step away from the trading floor and say, wait a second, what are we really doing here, right? In 2017, I gave a presentation stealing David Foster Wallace's, incredible speech, "This is Water," right? Where the analogy is drawn between, the story is drawn of, two young fish swimming by an old fish. The old fish says, "Hey boys, how's the water?" And they kind of look at him weird and they swim on a little bit. One of the fish turns to the other and goes like, "What's water?" Right? Well, we're all swimming in this medium that if you don't step outside, it's really hard to see, right? And I just think that change in perspective, and candidly, I've done almost everything in my career to give me the opportunity to look at things from a different perspective. Unless you do that, you can't truly understand the system in which you're participating.
I was going to ask you about the 60-40 portfolio and the outlook going forward, but I want to do it from this concept of the idea of simple versus complex, because, we've had one of the best 40-year periods probably ever for the 60-40 portfolio. And it's led to a lot of us thinking like the simplest portfolio is better. I get my broad stock market exposure, I get my broad bond exposure, I put it away and I'm done. And I'm wondering, like, how much of that is what's gone on over the last 40 years and how much of that is like simple portfolios are better? And then how do you think about that idea? Because I know as we start talking about your portfolio, you're introducing some more complex things here in search of getting a better return. So how do you think about that simple versus complex in constructing a portfolio?
So I think the irony is that the 60-40 portfolio is actually remarkably complex, but it seems to be very simple, right? And so again, put yourself back into the context of what has actually transpired in that 60-40 portfolio over the last 50 years, basically since Paul Volcker, right? So it's one of the reasons why, as we were talking earlier, I emphasized the dynamics of treasuries. My read on Paul Volcker is that he made a terrible miscalculation, right? Did not understand what he was doing in terms of fighting inflation, got sucked into the monetarist theories. He didn't hike interest rates for the purpose of hiking interest rates. He hiked interest rates as a byproduct of trying to achieve a stable growth of monetary aggregates in a period of high inflation, right? So if the demand for cash is rising significantly, which increases the velocity of money, in turn, you actually want to try to respond to that by restricting the availability of it. Theoretically, that's by hiking interest rates, right? That set up conditions under which interest rates were hiked to completely inappropriate levels. They actually were driving their own inflationary characteristics because of mismeasurement tied to the construction of CPI at the time. And so we were given this incredible gift of the U.S. government basically saying, hey, we'll pay you 20% a year, not quite, but we'll pay you 19% a year for doing absolutely nothing for the next 20 years, right? Like, sign me up, right? That sounds fantastic. What a fantastic possible outcome. That in turn set the stage for at least the 40 portion of that portfolio to nearly constantly appreciate over time as we slowly recognized that we had done something that at least in my view was completely inappropriate. But if you move beyond that error, and by the way, I think Jerome Powell has repeated that error, except under more adverse conditions, and as a result, we're likely to see an extended period of very positive returns for fixed income going forward, assuming we don't blow ourselves up in the process. And that's, by the way, a big assumption. Not to be overly dramatic on it, but it is actually something that you have to consider. What you're doing with the 60/40 portfolio is exactly what I was talking about in terms of the payoff characteristics, right? So you're buying a portion of the portfolio in that 40% that is directly tied to risk-free bonds. You're then buying a credit component of it that effectively consists of selling puts. You're then buying the equity component of it that consists of buying calls, right? And so you've built this payoff structure that actually is remarkably complex in its construction, but at its core had a number of factors behind it that I think are going to be very difficult to replicate, ranging from Volcker's initial error to the growth of passive investing, the general facilitation and ease with which people can buy equities. All of those things have changed the underlying structure, and in my opinion, at least represent a tailwind that may very much be becoming a headwind as we move forward.
Before we dig into the individual components, I want to get back to this idea of asset allocation, because most people, when we talk to them at this point, we'll say, all right, let's talk about the high-level components in your portfolio, and they'll talk about their stocks and their bonds, and they might say I have some commodities for inflation. And you're thinking about this completely differently, going back to the idea you talked about before with payoff structures. So how do you think, before we dig into all the individual components, how do you think about this idea? What components exist in your portfolio?
So let's take exactly that example, right? Because if you look at the current strategy, the Simplify Macro strategy, and you look at the exposure that we have there, you'll notice that there's two really critical things. One is that I've got a I've got a huge exposure to fixed income. Everything ranging from levered exposures through simplified products that give me increased exposure to the front end, to synthetic structures that I've created through various simplified products that give me exposure to yield curve steepening. And as I'm sure you've discovered and everyone else has noticed, like the levels of yield curve inversion that have been created by what I think is very clearly Jerome Powell's mistake are setting up conditions under which it's almost impossible to imagine the yield curve not steepening, right? Now, I do think that there's very particular components around the dynamics of the debt ceiling that may momentarily cause this to get even more extreme, but like you kind of have to play the steepener in one form or another, right? But if I'm thinking about those underlying exposures and what I'm really trying to accomplish there, I want to get a lot of exposure to the idea that I'm going to be delivered dollars in the future, right? With 100% certainty. That's what a risk-free fixed income instrument is. I give you fewer dollars today, you give me a guaranteed more dollars in the future. And what I'm articulating is, in terms of the option value, the flexibility, etc., a strategy that delivers me cash at some point in the reasonably near future is going to be of tremendous value, right? If I'm wrong about that, how am I going to be wrong? And what are the instruments that are going to benefit most? Well, instruments that are priced directly in the US dollar relative to their usage, i.e. commodities, are highly likely to appreciate significantly if I'm wrong about the future value of those dollars. So what I've actually done is, now let's go back to it, I've constructed a straddle that pays me dollars in the future. And if those dollars do not actually have the value that I expect them to have, then I've got the commodity exposure that pays me more. But I've done so, again, by utilizing a structure within the Simplify universe where I'm long a product that incorporates trend following dynamics to the commodity structure, et cetera. And that I would not do it any other way, right? Simply holding commodities is basically a recipe to get rats in your house.
How much of your portfolio is a reflection of your macro view, and how much of it is something that you would consider a core allocation? Like, are there parts of this that would always be in there in all circumstances, or is this a pretty flexible thing that could change dramatically?
So within the macro strategies that I run, and also within my overall portfolio, I try to approach it with a degree of, both humility in terms of like my macro forecasting tools are only as good as my actual ability to do so. And candidly, these are incredibly complex systems in which the misinterpretation or the ignorance of a single variable can radically change things, right? It's the proverbial butterfly flaps its wings, halfway across the world and a hurricane hits somewhere else, right? So I try to be relatively thoughtful in my construction and think about things in terms of overweight and underweight. If you look at my current exposures, I'm accessing almost all of my equity exposure through a relatively near the money call option on the S&P 500, right? So, and it's actually in the money. So when I say near the money, I'm not necessarily referring to out, and true paying for the option value of it. I tend to find that you do much better using options, particularly for things like the S&P 500, to express effectively a levered bet, which is what an in-the-money call option is, against a possible outcome, right? So if you look at the construction of that portfolio, I've got a relatively levered exposure that fairly closely matches my 60% target allocation, but at the same time does so in a way in which I'm very protected against a move outside of the current range should we move significantly lower. And by the way, I just actually increased the weightings in that portfolio, or the structure in the portfolio, to reflect the fact that I think the range that we've been moving in, we're rapidly heading towards a break of that. My bias is towards the downside, and that's part of my portfolio construction. But candidly, I can't know that, right? I just think that the odds of breaking that range are increasingly high. The weightings in terms of the fixed income space is where I would say that I'm actually taking outsized risk right now. And that reflects my general view that there seems to be this overwhelming perspective that the that the Fed is still being ridiculously accommodative because trailing inflation is running roughly 6%, and yet bond yields are only give or take 5%. Right? Or more accurately, bill yields, right? The front end of the curve is only around 5%. That to me is such a deep, fundamental misunderstanding of what you're doing with both of those metrics that I think it's almost impossible for there not to be incredible opportunity there. When people talk about inflation, remember what you're citing is what happened to prices last year. Right? When you talk about interest rates, you're talking about what's the return on your money for the next year, right? Or the next period, the next 30 years, for example, right? I don't see any reason why people should think those two are the same, right? I genuinely don't. There is a tiny component of autocorrelation, in other words, self-referential nature to things like inflation. But when you see the sorts of extreme moves that the Fed has taken, and you see the unfailing, the foreseeable breakage that is emerging as a byproduct of those extreme moves, I can't look beyond, at the next 12 months and see anything other than a significant deflation, or at minimum disinflation, in terms of the underlying characteristics of the economy.
Can you talk a little bit about leverage? Because that's something when people hear people talk about leverage, it immediately brings panic to their mind. Like, you're using leverage, you're going to explode. And, you really have a prudent way you're using leverage, but can you just talk about how you use leverage in your portfolio and how you think about that, sort of the proper amount to use, that type of thing?
Well, it's almost exactly like the dynamics of, buying a home, right? So what are you actually doing in the US marketplace? And Bill Gross and others have talked very eloquently about this, right? When you have rules around leverage in which I have the ability to basically cancel it, or I have a limited exposure to it, I can mail in the keys on the house that I bought with relatively limited adverse consequences for me on a personal basis. It can limit my access to credit for a period of time going forward, right? Like, leverage isn't nearly as scary in that context, right? Leverage is incredibly scary if you go back to the 19th century and I get thrown into debtor's prison if I fail to make good on my obligations. It becomes significantly less scary when we introduce, dynamics like personal bankruptcy or limited liability corporation exposures. And that's really what I'm tackling when I talk about leverage within my portfolio. I tend to use structures like in-the-money call options, which give me control over a large notional or nominal quantity of something, even as I'm limited to the premium that I've spent on that underlying contract, right? So the most I can lose in a call option is what I've put out into the contract. In return, I get to control for a period of time or benefit from potentially a large nominal appreciation. And candidly, I think the right way to think about the current structure in the market is it's not definitive or decisive in either direction right now. I can make very cogent cases for markets going much higher under a continued stimulus and fiscal stimulus framework, and Powell ultimately being forced to bend in one form or another. Not totally dissimilar to the stance that I took in April of 2020, saying, look, I know you guys think the world is going to end, but they're flooding the system with stimulus. This is hugely beneficial to the markets. We could easily see something like that emerge again, right? So if that's right, you want to construct the portfolio as a straddle. You want to be long extreme moves in either direction. And that's just the simplest description of how I've tried to build my portfolio right now.
Digging into your bond holdings a little bit, you have an interesting approach where you get exposure to high yield, but you also kind of couple that with a hedge against rising credit spreads. And I'm wondering if you could just talk a little bit about that strategy and how it works.
Yeah, so the simplify high yield with credit enhancement or credit overlay is the product that you're referring to. The ticker is very similar to a very famous Big Short ticker, right? We'll just leave it at that. So the problem with trying to hedge out credit exposure is that it's incredibly expensive if you're using options, whether those are options on HYG, for example, or if those are true credit default swaps. You have to remember that what you're effectively doing is neutralizing your exposure and just giving you a risk-free bond, right, that has some additional counterparty risk associated with it. If you time that perfectly, it can be brilliant, right? Bill Ackman famously bought CDS on high yield directly in front of the coronavirus events. Absolutely fantastic trade, returned probably 100 to 1 in terms of his payout structures. If we look at those same structures today, it's far more difficult to get that type of return profile unless you have immediate forecastability about an event not dissimilar to coronavirus, right? So like the debt ceiling may qualify, but that does not seem like the right way to really play the debt ceiling for a variety of reasons. What we do within that strategy is we instead tackle a slightly different angle on it, which is I've built a equity long short overlay that is designed to mimic what can be easily thought of as effectively the market's desperation to tap into refinancing, right? So I go long, high quality stocks, stable earnings, low leverage, very little need to either issue stock or to borrow on a continuous basis to obtain funds to allow them to continue to operate. It's what I call a quality component, right? So it's slightly different than other metrics of quality, but not totally dissimilar. Then going short a basket of securities from the Russell 1000 that have the greatest need to tap into capital market financing, right? They either have debt that is relatively high and relatively high proportion of their capital structure with relatively short duration to it. So they need to, the tenor on that debt is relatively short in terms of its construction, or they have poor operations, or a combination of the two is kind of the ideal, right? Where these are companies that are serial issuers. I'll just give a really simple example, Carnival Cruise Lines, right? Which as a company is both facing difficult operating conditions, and it also needs to continually refinance debt to the point that, in the last year, they issued debt when nobody else was issuing debt. They issued it at incredibly onerous terms because they needed that capital, right? So if I'm long the stocks that don't need to tap capital markets and I'm short stocks that do need to tap capital markets, it should behave almost exactly like credit spreads. But at the same time, I pick up a positive carry associated with it because I don't, in my long portion of the portfolio, I don't have the dilution aspects. I don't have the continual need to tap capital markets and be subject to that, effectively experiencing volatility drag. And we see this. It behaves like credit spreads, not perfect, but it behaves like credit spreads, and yet offers a positive carry component to it that I can then marry up against my high yield exposure to allow me to access credit in a hedged format. And that is actually the largest portion of the portfolio right now. I really like the underlying exposure of being long that quality basket, short the junk basket that in my view has broadly been inflated for a variety of reasons, inflation being certainly one of those. And then also giving me access to additional, risk-free exposure, which is really the reason why we see credit spreads compressed, right? Powell has hiked so aggressively that we see credit spreads as compressed, even as the absolute yields that companies are paying are super attractive.
Another thing investors struggle with sometimes is they want to manage interest rate risk, but they really don't know how to go about doing it. And I know you have an interesting product in your portfolio as well that looks to kind of hedge interest rate risk. And I'm wondering if you could sort of talk about how you go about that.
Well, so I'll be honest with you. That product, that strategy is the brainchild of my partner Harley Bassman, who's going to be infinitely better in the risk-free space than I'll ever be. The only difference between the two of us is I still have more hair, but beyond that, he's far more talented in that space. So the Simplify interest rate hedge product is one that most people are going to be somewhat aware of. The easiest way to think about it is it's simply a call option on interest rates. Now, it references a particular portion of the curve that Harley identified as being cheap to carry, both in terms of relatively low levels of implied volatility and attractive in terms of the structure of the forward curve, meaning that those rates are actually more under pressure than elsewhere. That product has some really unique characteristics. The most obvious one being that even though it's just an interest rate hedge, and so is exposed in the same way that a call option would be to the S&P 500 going higher, this is very well exposed to the level of interest rates going higher. Because it's constructed in that forward curve space, it has been punished, even though it's done extraordinarily well, it has been punished by the yield curve inversion. My primary interest in owning it at this point is not so much to protect against much higher interest rates, but really to protect against that dynamic of yield curve steepening and to participate in yield curve steepening. I love that overall exposure right now. I think we're going to find that the debt ceiling turns to be the event that causes the curve to start steepening to an extraordinary degree.
I want to shift to equities. When we originally had you on the podcast, we talked all about your work on passive investing, and I'll refer people back to that. We won't go through all that again. But I'm wondering, like, the implications of that work, like how that translates into how you're building your personal portfolio. Like, how does that change the way you construct your portfolio in that world?
Well, part of it is that it encourages me to actually do things like relatively long-dated call options, right? Because the simple reality is that if my theories around passive are correct, then markets have an underlying curvature to them. The more passive share gain that there is, the higher you actually mathematically end up in terms of valuations. And you can just, you can think about this intuitively in that a passive vehicle, going back to our earlier conversations, operates under the world's simplest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell, right? A active equity manager has an entirely different set of considerations, right? Do I think the stocks are a good value? Do I think that the return profile or the economy is going to do particularly well, right? So there's this whole filtration process that you go through with active managers that I would describe them as effectively, nervous buyers. If you dispense with the nervousness and instead you operate under a super simple mode that says, well, you gave me cash, therefore you want me to buy, right? Mechanically, that's going to push things higher, right? It's just that straightforward, right? And so it puts me in a situation in which I'd much rather have exposure to equities in the form of call options, recognizing that those call options can't properly price through that increasingly aggressive buyer base. It also has a secondary benefit that if for some reason that changes, and I would highlight that the biggest driver of passive growth is actually new employees entering the market. 100% of them are effectively being pushed. It's like 95% of them are being pushed into passive vehicles that, again, just take their paychecks and plow them to work, right? And does so in a manner that exhibits zero fear, right? So if that's the underlying case, and if that's going to continue, then markets will be propelled higher in valuation. Call options should benefit from it. On the flip side of that, if anything causes that to change, for example, a relatively deep recession that hits employment or hits the retirement benefits of white-collar workers in the form of 401ks and other resources, then that portfolio, the markets can fall far more rapidly than anyone has forecast, similar to the dynamics around XIV collapsing, right, as we saw in the Volmageddon events. And under that framework, I want to have a risk limited exposure, right? So again, it drives me right back into the call option framework.
In that world, would you ever care about valuations for equities? Like we had Med Faber on the podcast, and he did this thought experiment on Twitter where he kind of started raising the CAPE ratio over and over and doing polls like, would you own stocks? Like I think the CAPE got to like 45, I believe, in the .com. But like, what if it got to 100? I mean, is there any framework or any part of that world where you would care about valuations, or is it something that doesn't really impact your equity allocation?
So, this is the great irony, right? Like, I deeply care about valuations because I fully appreciate that, among other things, that influences exactly the components that I was highlighting before, quality versus junk. Companies that don't need to tap the capital markets are technically at a disadvantage in that type of inflation, right? Because tapping the capital markets and raising cash and selling securities into that market, as we saw with any number of SPACs and nonsense stocks in 2020 and 2021, is like the super winning strategy, right? It sounds insane, but if you actually enter into a world in which people don't care about valuations, then man, sell them as much as you possibly can, right? What a winning strategy. I can't break entirely with my past, right? I was a value investor. I came up through the small cap value ranks. I went to, I have a degree in finance. I understand the dynamics of discounted cash flows and that future expected returns should be lower when valuations are lower. But mechanically, that's just not how the markets work right now. And it causes any number of endless fights with guys like Cliff Asness and to a lesser extent, Med Faber, who will correctly point out, well, like valuation does matter. I'll say you're 100% right, except nobody at Vanguard cares, right? And nobody who's buying through Vanguard cares. And in fact, it actually works in reverse because what we have right now is a system where smart, talented, thoughtful managers like Cliff Asness are being fired and replaced by people who don't care, actually who have a negative value signal because it's all momentum based. As long as that's happening, I can't get myself too worked up about valuations.
Yeah, it's hard being an investor like trained in valuing companies. It's hard to separate yourself from that. It's hard to say like these structural issues are going on. It's hard for me too, but it is certainly true. And you see some of the great investors, like I forget which someone was on Patrick O'Shaughnessy's podcast recently.
David
talking
Einhorn.
about this. David Einhorn, that's right.
Yeah.
And he was talking about this. He's accepted this fact now, and he's still investing in companies, but he's really looking at like things like how much buybacks are so huge, relative to the company that he knows he's going to get his money back. He's not betting on valuations returning to normal anymore. Like that's not part of his strategy. And I thought that was really interesting.
Yeah. So David and I are good friends. And when I walked, so David was among the many people that I went to in 2017, 2018 to basically say, am I crazy? Like this is the math of what I'm seeing here. Am I totally crazy? And David was one of the most thoughtful in terms of his reaction and behavior around it. One, he very deeply considered it and came back and said, okay, unfortunately, I think you're right, which has, been a source of the genesis of him now, focusing on that. How we've chosen to treat it, I think, reflects to a certain extent our underlying exposures, right? So David is a billionaire and I am not. Right. Let's just lay that out there in just the simplest form. I'm focused on acquisition of capital still. David is largely focused around preservation and continuation of his status and is seeing this correctly as an opportunity to pick up assets from forced sellers like other value managers. Right. So he doesn't manage nearly as much outside capital, if any, relative to what he used to. And it gives him tremendous flexibility to say, okay, I have a different strategy in how I'm going to handle this than Mike does, even as I completely agree with his underlying philosophy. And by the way, I think that's an enviable position to be in right now. The problem is that David is largely insulated from the day-to-day ramifications of that. And so he can build a claim on future cash flows, which is what he's really describing, in a manner that is super, super valuable without having to worry about the daily vicissitudes of, do I make money? Do I lose money? Do people fire me? Do they replace me? Et cetera, et cetera, et cetera, right? It's a luxury, but David is brilliant, and I consider myself fortunate to have him as a sounding board of one of the people that I talk to about this on a very regular basis.
Yeah, career risk is definitely a big thing. Not for him, but for a lot of other people. So obviously, depending on the degree of your career risk, you have to manage your portfolios a little bit differently. I think for all of us.
Yeah, no, and that's one of the points that I try to make clear in these underlying discussions around this stuff is like, understand it's not that I disagree with Cliff Asness that value matters. It's not that I disagree with Meb Faber that value matters, right? It just like it means something different when the machines have taken over and we've failed to program them properly. And that's what's happened.
One more thing on equity exposure. I just wanted to ask you, what do you think about international exposure? You have different camps. You have like the Jack Bogle camp that says, you're getting everything you need here in the US. And then you've got other people who use maybe more advanced models with correlation and stuff and say you are getting a lot of benefit from investing internationally. Like, how do you think about that?
So I think that there's so first, like I'm always in favor of diversification. I think that there are very clear benefits associated with putting a claim against assets that are earning income, both not in your native currency and not in your native, what I would describe as, meat space legislative, capture, right? So if you're in Syria, for example, we wouldn't even be having this conversation, be like, okay, how do you access the S&P 500? How do you get out of your country, right? It's just a ridiculous luxury that we sit in the United States and say, what do you think about international exposure? And we can debate it, right? So the obvious answer is that you should invest, but just like the value factor, the idea behind the value factor, the idea of accumulating claims on future cash flows, there's unfortunately a wrinkle to it that's created by the underlying characteristics of markets today. If I look going back to those same dynamics, 90+% of the marginal capital is now coming in through vehicles that attempt to buy equities, both domestically and internationally, not based on their underlying characteristics of cash flows, or are they growing more rapidly, or do they offer excess return in the form of dividend yields or stock buybacks, etc. Instead, it's simply a function of, based on some historical return profile and correlation characteristics, we're going to put 15% of the portfolio into those, right? So what that means is that within the U.S. framework, if I'm thinking about this, of each incremental dollar that goes into equities, most of these target date funds and structures will put something like 80% into U.S. assets and 20% into international assets and take down the international assets more rapidly. U.S. equities only make about 50% of global market cap. That's after significant appreciation. And on the flip side of it, you have this relatively low allocation that's going out to the international assets. The international assets, to go back to the quality junk framework we were talking about, they're huge capital issuers. Why? Because it's growing more rapidly. They need more capital. They need U.S. dollars to put to work, et cetera. You see this in terms of share issuance. So there's dilution, the opposite of what David's looking for example. At the same time, less money relative to market cap is flowing into those spaces by virtue of these fixed investment structures. And so we end up with this perpetual underperformance that, from my perspective, is going to be very hard to break under the structural and systematic frameworks that we're currently operating under. And I just want to be really clear. I don't think it has anything to do with fundamentals, right? I don't think it has anything to do with diversification benefits. I just think it has to do, if I mechanically say, put 20% of my money into international and 80% of it into the U.S., and the U.S. companies are largely shrinking their capital while the international companies are tapping the capital markets, it's like an extreme version of my quality junk. And it's been one of the highest Sharpe ratio trades of the past 15 years, is to bet against emerging markets, right? Or rest of the world.
There's just one more component of your portfolio I want to ask you about before I hand it back to Justin. I want to ask you about managed futures, because that's something that people weren't talking about for a long time, and now they are talking about it because they've done a lot better. But how do you think about incorporating managed futures into your portfolio and sort of the return profile you're looking for when you bring them in?
So in general, managed futures means trend following, right? And so, what you're really doing with managed futures is you're trying to tap into effectively movements that are increasingly self-reinforcing, which is the easiest way to think about trend following or momentum. Again, that for me is part of building an option like Payoff in my portfolio. Things that have that positive trend following characteristic means that I get more long as it gets reinforcing flow action. It means I get more short as it gets reinforcing negative flow action. That gives me a payout that, managed futures basically looks like a straddle. and yet I don't have to pay the volatility premium to obtain that straddle, right? And so it is a low vega, to use the official term for the option Greek on volatility. It is a low vega approach to gain access to that straddle payoff. Again, something I desperately want because we don't know what's going to happen next.
You have two other positions in the portfolio that are meaningful. One is gold, and that's not a huge position, but it's still represented in the portfolio. And then you also have a strategy that harvests the volatility premium. So can you just talk to both of those and what benefits you see as those being holdings in the strategy?
I love that you guys have done your homework so well on this stuff, by the way. It's fantastic. So the vol harvesting strategy is the exact opposite of what I just described. It's a short straddle position that allows me to, in a very defined way, because of the way we've built that structure, we buy back some of the exposure on the extreme moves. It becomes much more fixed income like, right? And so that actually is really just a way of tapping into an alternate form of that fixed income exposure that we were talking about before, where I've diversified away from the high yield component and I'm focused in the S&P 500, which is actually functionally investment grade exposure, right? So it gives me a payoff that's very similar to credit. It gives me a payoff that is risk limited in its overall exposure, but allows me to capture income with which I can fund all the other stuff that I think is interesting. Gold is effectively insurance against this idea that I can, quote unquote, trust central bankers. And yes, I used air quotes for those who are not watching, because nobody should trust central bankers, much less as far as you can, certainly not as far as you can throw them. That was easier with Janet Yellen than Jerome Powell. But the simple reality is that what I love about the idea of using gold is Jim Grant's timeless expression, which is the price of gold is 1 over N, where N is faith in central bankers, right? It is the diversifying asset away from, similar to the commodity trend stuff that I was referring to, it's the diversifying asset away from how valuable is that dollar I'm going to receive in the future. And it has some interesting characteristics. Now, as you point out, it's relatively small. I'm not a gold bug. I think the gold is actually deeply flawed. In many ways, I'm more sympathetic to Bitcoiners in terms of we'll move to something in the future, but I can't deny that it does have those payoff characteristics. And so as a portion of my portfolio, it's something that I hold. By the way, that's something that I hold on a personal basis as well for exactly the same reason, right? I want to have something that physically I can throw at zombies if they're going to attack me.
How do you think about rebalancing or making changes to this? I mean, one of the nice things about the ETF is that, you can do it very tax efficiently. And so the changes that are being made, but how sort of often are you in there tweaking these positions, reweighting these positions, taking gains, taking losses, and sort of how does that sort of work in the real world?
Yeah, so it's a great question. It's exactly why I moved to the ETF space, by the way, with the introduction of what's called the derivative rule in September of 2020 that allowed efficient inclusion of derivatives within ETFs. In my view, that fundamentally changed the game, right? So anyone who's offering a derivative heavy strategy outside of ETFs, in my view, is only doing so because they want to capture the excess return associated with the hedge fund structure, right? Where I get paid more to manage and I get to capture a significant fraction of the upside. From a high net worth individual standpoint, hedge funds are incredibly inefficient, particularly if they incorporate derivative dynamics. You're paying short-term gains on basically everything. And by being able to replicate that within the ETF, I get rid of that, right? So it is the quote unquote right structure for the investor. It's a structure that is less advantageous to the manager unless you're able to slowly grow the asset base over time. And then obviously anything can work out well if you do well. So in terms of how actively I'm managing it, one, again, remember that most of what I'm trying to do within these strategies is to invest in the other simplified strategies that we've developed to fill out this portfolio. And so part of the reason we didn't launch the macro strategy earlier is because we just didn't have many of the exposures that we needed. You've also seen us use the macro strategy to introduce strategies that we think are particularly attractive, I would highlight our levered 2-year bonds, to a lesser extent, our levered 5-year bonds, the introduction of our commodity strategy, the introduction of our managed future strategy, et cetera, have all been facilitated by inclusion within the macro strategy portfolio. That frees me up to spend much more time on kind of the fun stuff, right? The individual derivative exposures that I'll have, how to pick exposures within, say, for example, the S&P 500, where I think I want to capture a particular expression. And, my latest trade actually did exactly that. Fortunately, ahead of today's move, I, took my options exposures, which were relatively deep, fairly deep in the money, and therefore offered relatively low leverage to a move. I was comfortable with the framework that we were operating under in terms of the low vol regime. And I got to be honest with you, I looked at the underlying dynamics of the extreme low levels of volatility and chose to change that in the past day or so. So I took about $1.5 million out of my equity exposure, managed to keep that in a higher vol framework, moving to a further out of the money, slightly longer duration option exposure. And if I were to do that within a hedge fund, I would have incurred significant tax penalties. Because it happened in an ETF, I was able to largely avoid that. And so that's the only, look, nothing that I'm doing is rocket science or necessarily, and to steal from the John Bogle framework, right, worth 75 basis points, right? You can recreate much of what I'm doing through relatively low cost, simplify exposures, or through individual exposures to the S&P in a 3 basis point Vanguard ETF, right? But by combining them together under the umbrella of a single unified ETF, I'm able to shield some of those tax consequences and, in my view, make it a much more valuable portfolio overall.
As you look over the long term, are there things that you can't do right now with ETFs that you think you might be able to do in a portfolio like this over the long term? Like I was listening to an interview you did, and you asked yourself 2 questions in your portfolio. What would I like to do, and can we do it currently? And so I'm wondering, is there anything that is yes to the first question that's no to the second question right now that you think might change in the future?
FX. I desperately want to get an FX product out there. It is for me the glaring hole right now. And it is the one area that I would broadly highlight has not seen the dramatic increase in volatility pricing that has occurred elsewhere. I find that to be tremendously ironic, given what looks to me like what could very well be a currency crisis, much less around the US dollar actually, and much more around effectively the fracturing of a monetary system, where it's turning into the allies of China versus the allies of the United States, right? That type of shift really only happens once every 50 years or so. The last time it occurred was 1990, and man, did that work well for currency traders, right? That's where George Soros broke the British pound. That's where trades around the Russian ruble just became extraordinary. Like, all sorts of really interesting stuff occurs during those transitions. And, I'm fearful that we won't get there, but I think we will. I think we've got a little bit more time before this really begins to hit.
Towards the end of these interviews, we kind of like to step out of the strategy a little bit and ask you some things about maybe some other investments that you have or don't have, and just some other things. But you mentioned you have obviously the stake in Simplify, you have some other private company investments. Do you do anything else in private equity? Anything else in real estate? Or what does the other, investments look like outside of your portfolio?
So I got really lucky in real estate investments. I managed to buy apartment units and multifamily residential in the aftermath of the global financial crisis. We sold all those the last of them actually we sold in 2021. So while I did not do great on my personal house, I'm going to do fine, because like every other old person, I'm indexed in a way that young people are correctly envious of. By the way, for those who are younger and listening, I desperately wish that we would fix, permitting and allow you guys to buy houses. But part of the great irony is that there's this narrative out there right now that says we need to get home prices down so young people can buy them. Like, guys, that's not the way this is going to work, right? If home prices go down to the degree that makes them affordable with interest rates at this level, you're going to lose your job. So you're not going to buy that house under that framework. It turns into corporate ownership and everything we've seen in terrible fashion since the global financial crisis, just put on steroids. So I was fortunate in terms of the relative timing of the multifamily residential real estate. I actually don't have any exposure to private equity, which is somewhat interesting. But part of that, other than a lot of friends who have made more money than I have who do private equity, and part of that for me is that I like private equity is just levered equity, right? So I can replicate the return profile through owning in the money call options on the S&P 500. This has been documented over and over and over again. The private equity is just a way of paying somebody for owning effectively levered S&P exposure, or more accurately, really levered Russell 2000 exposure without mark-to-market characteristics to it. So I'm not sure why I would choose to do that. Whereas venture is an asset class, or true private in terms of enterprises that I can directly influence in terms of my individual contributions, whether that's through assisting a young management team in identifying strategic issues or problems, or whether that is through my direct contribution in things like Simplify or Tier 1 Alpha. Those seem like much better ways to invest my time than private equity. By the way, I've been wrong about that for 30 years, right? So take it for what it's worth.
Do you do anything with in the crypto space or no?
So the quick answer is yes and no. At Simplify, we have strategies that have exposure. I've gone on record and said I do not necessarily support these, but I understand why people do it. And so in particular, we have a strategy which offers S&P exposure with Bitcoin overlay to it. That product was introduced directly as an output from a debate I had in Bitcoin space, where I was asked the question, well, what's wrong with a 1% allocation to Bitcoin? And the answer to that actually lies with financial advisors like yourselves, right? If I ask you to manage a 1% allocation to an asset as volatile as Bitcoin, the reality is that you're going to distract the hell out of yourself in the process of trying to maintain that exposure, right? It's just mentally not good for you, for me, for anyone else to do that. And so in the same way I've talked about the dynamics of exposure within my macro ETF that gives me a tax efficient way to tackle that, we have that embedded within that strategy where we rebalance the Bitcoin exposure so that it's constantly 5 to 15% within this underlying exposure to the S&P. That makes it very easy for a financial advisor to offer a 1% exposure to their clients. And to me was kind of an opportunity that should be reflected in there. With that said, I think that the entire theory behind crypto is both super valid in its observation that we need to move away from paper-based and truly analog systems like stock certificates and debt prospectuses to tokenized securities where everything is available to me to instantly search and understand what all the characteristics of this security are, moving away from the record keeping, the onerous characteristics of truly paper-based systems, which is what we still have. But the nonsense that accompanies most of the crypto space, every good fraud has a degree of truth to it, or you wouldn't believe it. If I came out and told you, you should be investing in unicorns, no, not billion-dollar startups, things with horns and magical fairy tales, right? You'd be like, this is, completely ridiculous. Who is this idiot? If I tell you something that has a degree of truth to it, that the current system is not particularly functioning, that the current system needs to move to this new world in which it is natively digital, then I can defraud you of anything I want, right? And that's largely what it's been used for so far. There is a great and glorious world on the other side of this, where we do have digital securities, we do have native tokenization, we do have increased ability to create innovative new products that tap into all sorts of things, allow me to create my own structured products if I want to. I'm very excited about that world. But as it exists right now, I'm not doing anything in it.
You've had a successful career as a investor, but I'm wondering when you think back to your experience and when you think back to maybe a key mistake or the biggest mistake that you learned from, what would you say that would be? Not investing in private equity? No.
Yeah, probably. No, I mean, so look, I consider myself really fortunate, right? And so I'm not as, I've done very well. I'm not as rich as some people I know. I'm certainly not as rich as many people out there. But I consider myself to actually be extraordinarily rich in life experiences and the life that I've lived around it. And so I don't spend a lot of time thinking or regretting the choices that I've made, right? My favorite, kind of sappy saccharine movie is one that I share with my daughter in terms of our favorite. It's a movie called About Time, in which the individual has the ability to travel backwards in time and change decisions that he makes. And one of the key realizations in this story is actually that once you have kids, once you've actually set yourself down a life path, you actually can't change those things. And that for me was probably the single greatest realization, that I wouldn't change anything, right? I mean, within the investment world, it's super easy to be like, man, I really wish I'd bought Apple at, slightly negative enterprise value in 2005, right? Or 2003, which you had the opportunity to do, by the way, right? I wish I'd put everything into Bitcoin in 2010, pick the nonsense fantasy that you want to live. Those are incredibly available to us because we can recreate it through the history that's available to us today and the knowledge of what exists today. But why? That's almost a waste of time, right? That type of backtesting, that type of fantasy is totally, specious. Now, I've made any number of investment mistakes, and I've tried to learn from those by saying, what did I do wrong given the information at the time? But for me, the worst criteria for did I make a mistake was, has something worked better than I thought it was going to, right? All I'm going to do is spend my time going back and saying, what were the foreseeable errors that I could have avoided in that process? And I've talked about those, terrible investment that I made in 2006 into a copper miner in Colorado, in which just the chemistry was wrong, right? And I relied on experts to produce the reports that led me to make the investment. And it was ultimately me just doing simple math, looking at it going, oh my gosh, they screwed this up. How could I have missed this, right? How could I have missed the chemical composition of the rock in which they were doing the extraction? It was a talc-based rock that, just sucked up acid, right? Made it super high cost. Those are mistakes you can learn from. Man, I should have invested in private equity or Apple 30 years ago or Bitcoin in 2010. Who the hell cares? It doesn't matter. Again, I got lucky. Things worked out well. And now I get to sit here and watch my children hopefully do the same thing.
On the Apple and Amazon point, also, it's hard to put yourself back into what the world looked like then. If you think about investing in Amazon and, I could have had this amazing return, at the point you would have had to buy to get that amazing return, people were not saying positive things about Amazon. People were not thinking anything about AWS. AWS didn't even exist. So it's so easy to look back, but it's so hard to put yourself in that situation and say, with what I knew at the time, what would the world have looked like?
Well, there are some examples like that I can actually look back and say that was eminently foreseeable, right? And there's a great conversation that I was privy to between Bill Miller of Legg Mason Value Trust and Warren Buffett, specifically about Amazon, where Bill Miller went out and tried to get Warren Buffett to buy Amazon, and he highlighted the preferreds that existed at Amazon at that point. He's like, Warren, do you understand how bad things have to be for these prefs to lose money? And Warren said, I've already bought them, Bill. I'm like, okay, well, there you go. That's kind of everything you needed to know about some of those situations. Those are very real situations that exist. There were real reasons to buy Amazon at the time. It was trading on a price to sales basis below that of Walmart, despite radically different growth expectations. But just remember most people are going to be too young to remember this now. It's one of the downsides of getting older. But if you went back and you listened to the discussions around Amazon in 1999 and 2000, the outrage was not that Amazon would emerge as a competitor to Walmart. It was, can you believe that Amazon is more richly valued than Barnes and Noble? right? That was the discussion, right? So all this nonsense around like it's the world's most valuable retailer, et cetera, or AWS, right? Like, man, that was just optionality that existed from a path that Jeff Bezos pursued to his credit.
Picking up on your idea that life is a lot more than money, we like to ask a question when we close these out about something that you spend money on that may not be the greatest investment, but gives you a lot of value in your life. Like I always use the example, I'm a big sailboat racer. So I have a sailboat, which is obviously not a very good investment in terms of the upkeep and the money you have to put into it. But I can go out on Wednesday night with my friends and I can have a beer and we can race around a course. And like, it's just a great life experience for me. So I'm wondering, do you have anything like that in your life that maybe is not the greatest financial investment, but you consider a great investment?
Oh, good quality cooking stuff. I love to cook. I genuinely love to cook. Drives my wife completely insane that my kitchen can basically be described, and it's funny because most of it's packed away right now, and so I'm in a relatively short-term rental. As you know, our house is empty to be efficiently sold on the market, and I'm operating basically with a couple of cast iron pans and a Instapot and a few other things. And I got to tell you, I'm having a blast, simplifying all this sort of stuff, not using a, blowtorch for searing steak, instead using, a pan and butter and everything else. Like all that's kind of fun, right? So I actually, it's funny because like I fully invested in basically every kitchen utensil that, mankind can buy. And now I'm like, maybe I kind of want to simplify that too. So,
yeah, so you're not just simplifying in the ETF world, you're simplifying in the cooking world as well.
No, it's one of the great ironies is that we're not simplifying the ETF world, despite the name. We're complicating the ETF world through some interesting products. But yes, maybe I'll start simplifying my kitchen.
You got to go social with, as you're traveling in this RV, how you're able to make great food, but with, just a few pots and pans.
I legitimately have thought about it, and it was funny. I was sending my oldest son, is just about to enter the corporate world. He's got his first job just outside of DC, and ironically working on indexes. As I was helping him think through his budget, et cetera, he wants like a meal prep plan, right? So food delivered to him that he can very easily prepare. And I'm like, Brian, like, how can you miss out on the opportunity to cook, right? Let me send you some recipes that, you can like prepare, 5 servings in advance and just freeze them and easily prepare them. It's going to be 10 times better than the meal prep, etc. He's like, Dad, I don't have any interest in that. I'm like, totally fail. But I will actually, I do look forward to doing exactly that, being on the road, sending people pictures of, really good fried egg sandwiches, cooked up over a campfire and everything else.
So in closing, we like to ask our guests one standard closing question. That is, if you could impart one lesson you've learned from building your personal portfolio to the average investor, what would that be?
Oh, just remember the portfolio is secondary to your life. Like that I honestly think we often really lose perspective around that. And I just continually emphasize, it's part of why you hear me railing against the behavior of the Federal Reserve, et cetera. We behave as if everything is about financial outcomes, as if the market tells us truth. There is no truth to be found in financial markets. There is no truth to be found in financial assets. There is no truth to be found in your relative success in terms of your wealth or anything else. The truth is to be found in the smile of your child, the greeting that your wife gives you when you come home, et cetera. Enjoy life and try to be a better person every single day in that context.
Thank you for that, Mike. We really appreciate your time. Good luck on the trip. And if you find yourself up here in Connecticut, let us know. Jack and I will get together with you.
I would love that. Thank you very much, guys.
Thank you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.